Well, good morning, everybody. I hope you guys are doing well. Welcome to the first inaugural annual ever OO show, a show that we'll be doing Monday through Friday, 8:45 Eastern to 9:30. And so with me today is a very trusty co-host that I don't deserve to be a co-host with, Mr. Dan Sheridan. Dan, how are you doing?
I'm doing fine. Good morning, everybody. Glad you're here. It's a beautiful day here, yeah, happy to discuss a wide range of topics with you today.
Yeah. So for those,
wide range.
This is going to be a show where in the market we look at markets, we look at options and things like that. But we also try to talk to each other like humans a little bit and not just give straight to stuff. So
Right.
With that being said, what the plan is we want to give something for everybody. So we want to give stuff for beginners who are complete. If you've never traded options before, hopefully you can learn some stuff here. If you've traded options a long time, hopefully you can learn stuff here. And we'll go every day. There'll be some days. The beautiful thing is the market gives us news every day in some ways. And so there won't be a lack of conversations to be had.
Right.
So what we'll do, though, is we're going to start with a brand new segment because the whole thing's brand new, called the Zero DTE Rundown. And we have three things, very important things on the 0-day rundown. So, Dan, first off,
yes,
the market Friday, if you were selling a range bound strategy, you probably thought you were doing really, really well until about 3:30 Friday.
yes.
And then something crazy happened where we rallied roughly 70 to 80 points in about 20 minutes. Now, you've been in the game a long time, Dan. What are those days like, and what do you do in those days? And I'd be interested, for those who don't know, Dan was a market maker for a long time on the floor in Chicago. What happens during days like that when you guys were in the pits and stuff, crazy stuff happens?
Well, back then, before it was electronic, now it's electronic trading. So if you were to go on a little field trip to the CBOE, it's very quiet, right? Whereas before the electronics, it would be pandemonium. People would be yelling and screaming and elbowing. And so it was you could tell years ago what the market, any change in the market, like a big candle and things changing, the noise level would go up like at a sporting event. Nowadays, you go to the CBOE and you look down at the traders they have these big glass windows you can look at. You can't tell anything, right? I mean, so the noise was a big deal. Like the S&P pit at the Chicago Mercantile Exchange, I mean, the noise was a positive, right? It was a positive that you could see. So, I mean, to me, the big story last week, Troy, without a doubt, were the candles, right? And we're not talking birthday. We're not talking birthday candles, Troy. We are not.
I wish we were.
Well, I mean, here's an interesting statistic. Not that I'm a big statistic guy. If you look at the average range and the range in the SPX between the high and the low for last week, the average range was 97 points between the high and the low. I have not seen that. If someone can tell me when in the last 6 months, year, 2 years, we had a week where we had bigger candles, bigger ranges. Obviously, Thursday and Friday carried the way. Thursday was 135 points between the high and the low, Friday 122. And so you say, what does that mean if I'm a range-bound trader? One word, and it begins with W, whipsaw, right? Big time. So you got to be careful. I got whipsawed 2 or 3 times last week on range-bound trades, and it's just, you got to be more careful. But I think it's like you got to realize you're in it, right? If you don't realize you're in kind of a whipsaw, and I mean, just give you an example. Monday, the range was 66, Tuesday, 84, Wednesday, 79, Thursday, 135, and Friday, 122. So I think Now, part of the coming up, if you say to me, if someone said to me, do you ever get that concerned on big moves on the upside? I would say usually not, right? Usually. But the times that I'm most concerned, Troy, with moves on the upside are after we've been down 4 or 5% in the market. And if you look at the lows on even Friday, as of the lows Friday, if you look at the highs of 61.47, we were down about 5%. So, which takes it almost, what would you say, almost 280, 300 points from the highs. And so when we come up, it's not coming up 5 points. So when the market decided, all right, to me, the big kicker was VIX never got out of line Friday, right?
Yeah.
Volatilities were, there's no panic. If you're not seeing the normal range in VIX over the last year, if you excuse August, is like 19 to 21. So if we're not seeing 24, 25, there's no panic, right?
Yeah.
There's no panic if we're in the normal range up to 21. And so I think after a while on Friday, it was like, okay, or Thursday, even Thursday, where are we going here? Right.
No, right.
And so there was no panic. And so if there's no panic, where are we going? We're going back up. So, and today, VIX should be, if we open up 30 or whatever, VIX could be back to 18 or something. So, as much as people wanted to go down, telling the market to go down, willing the market to go down, demanding the market goes down, it's not feeling it right now, right? And so so bottom line, so what should I look for? Look for VIX 23, 24, 25. If it's not going there, it's just not going to happen. And so I think, again, Whipsaw was the name of the game. I think it'll continue. I don't think the big candles of last week, I don't think we'll have an average of 97 points between the high and the low. And again, people say, well, what's the significance of big candles? If you're a range-bound trader, if it moves too far one way or the other, you might have to do something, right? We would call that an adjustment. And so with these big moves, it caused you to maybe make some adjustments, and then you could get whipsawed. So anyways, that's as my Irish grandmother would say, Troy, that's to make a long story short.
Well, no, I agree with you. And I think that I was telling someone Friday, I really don't see any fear in the market. To your point,
No.
you don't see, the VIX has been really orderly on a pretty big sell-off. And, for those who don't know, I mean, the VIX is basically a snapshot of farther date out options, put options on SPX. And so what that's telling you is that it's, and normally the VIX goes up when the bid ask widens. That's literally how it's going to work. And so liquidity is getting taken out of the market the higher the VIX goes. Well, liquidity really wasn't taken out of the market last week. The other thing I thought was really interesting, Dan, is when you look at last week's moves, even some of those big moves down, the indexes were pretty rotational. And so obviously the Qs led the down move, but the Dow stocks really weren't following too much. And what that shows me is that money's just rotating. Money's not being taken out of the market. You'd see that with a higher VIX. It's just that the market is rotating right now. And those are can be frustrating times for people because you have these big down moves with no follow through. And thus, if there's no follow through, to your point, it's got to go somewhere. And it's not just going to sit there 300 points down. That's what we do know.
That's right. And even like you said, if you look at the different sectors, it wasn't like all red with the sectors in the S&P. XLF, XLV, XLP were up pretty good for the week. It was just the main culprit, as usual, was the XLK, the technologies. But it was a rotation. It wasn't all red, Katie bar the door to the downside. So it's kind of interesting. You've got this market that went down begrudgingly, right? 4% or 5% from the high, begrudgingly. And now it's just saying that may be the best you're going to get right now. And so I think for the next week is, and here's an interesting thing. If you look at the expected move for last week, we were well in the expected move. We were only down. I mean, you look at S&Ps were down 56 points, 59 points SPX for the week. much less than the expected move. And VIX was up almost 1.5 points for the week. So from the expected move, you could say, and this is the dichotomy, whatever that means, Troy, I couldn't spell it. I don't even know what it means, but the word came up. So I must have been influenced by somebody who said the word dichotomy. I hope it
for sure.
Yeah, but you have this thing where, okay, SPX says it was an easy week. What are you complaining about with range-bound trades? But on the other hand, when you look at the candles, you say, was the market down 500? What the heck happened, right?
Yep.
And you just have this schizophrenia, and you could say it, who knows what the catalyst is? People could say it's Trump's fault, it's the terrorist fault, or whatever it is. Those are catalysts. But again, I think Friday, if you asked me, coming up a lot, I think forget the catalyst. As if we're down 5% and there's no fear in the market, when we come back, we're not coming back 10 points, right?
That's right. Yeah.
And so I think just, again, as traders, you trade what's in front of you, right? We don't go back and say, a year ago when the sun was nice outside and I was having my lemonade and I could put on this trade. We're not in that environment right now.
That's right.
So deal with it. This is it. This is where the VIX is. This is how the market's moving. If you can put trades on that you're comfortable in this environment, and there's trades that are definitely doing well in this environment.
Yeah.
Especially if you don't get whipsawed. But I mean, there's trades like we'll wait on the trades thing. But
yeah.
Anyways.
Well, no, that's the nice thing is the market will give us some more information this week about what it wants to do, and it gives it to. Yeah. It usually gives the information to me about a day after I needed it.
That's usually mine too.
Yeah, but it'll definitely give me the information. But really, I mean, everybody's here because they want to hear us talk about basketball, and that it's really a basketball show. So here's my question. For those who don't know, Dan and I get breakfast a lot, and Dan's been my mentor for a long time. And I love how Dan trades. I love everything about Dan, except for this one thing. Dan loves NCAA basketball more than NBA basketball. And so I wanted to just get this on the record. Dan, why is NCAA basketball superior to NBA basketball?
I mean, it's the first thing that thought came into my mind, Joel Embiid from the Philadelphia, right? Guys that are, that's the first thing that came to mind. It's like, and in the NCAA, if they're missing 3 toes, they'll play, right? It's every game is a war. I mean, you look at yesterday classic is, Tennessee and
Alabama.
I mean, it's just the intensity, the excitement, the lay it on the line. I guess it's changing a little bit. You could say up until the last 2 years, you could say, look, they're doing all this for nothing, right?
Yeah.
They're not getting anything. Now, yes, it's changing, which is good. I just think the NBA is just, on a typical night, who's playing? I mean, I think back when I was, I'm a bit older than you. And so when we had Michael Jordan and I lived in Chicago,
here we go.
Michael Jordan could have, his knee popped out, the bone showing, and he's on the court, right?
Yeah.
And he'll score 30 on somebody. Now, if you're a sniffle or your toe is just, he rubs the other toe, you have your doctor or your surgeon, you need to so these guys don't play, right?
Yeah.
And I just think it's on typical nights. What are you watching? So I just think the product is not, until they can find a way. If it was me, Troy, I'd get rid of all the team doctors, all of them, right? Just get rid of them. Let the guys play, because I think there's something to be said when you're playing. I'd see at the YMCA these guys that are 60 years old running up and down the court for 2 hours, and they're there year after year. They're not taking off these special injuries. They're not getting a beautiful massage at night and all those kinds of things. And I just think it just seems to me these guys, I mean, come on, what's going on that you guys can't play? What is it, 2 games a week or something like that? So anyways, Troy, that's my my thing.
Well, Dan, I love you. I mean, you couldn't be more wrong, but I love you for it. I appreciate it.
I like it better when LeBron retires. When he retires, I think I'll go back to the NBA.
That's what I was waiting for. Yeah. I mean, here's my only 2 points I would add to that are, one, I don't for one moment presume that those college basketball players aren't getting beautiful massages at night. But that's true.
That's true. That's another story. Yeah.
But two, here's the thing. I'm 41. My knees don't feel quite as spry as they did 10 years ago. But, on any given night, this is the thing. Everything you said about the NBA is true, that they do get a little lazy during the season. But I'll say that they're really, in my opinion, there's nothing better than playoff basketball, NBA basketball.
True. Absolutely.
Because
I agree.
Even March Madness, I mean, it's fun, but the fun of March Madness is that any team can beat anybody anytime,
Right.
and you have one game. So you have to,
Right.
but it's like the Super Bowl. There's a little bit of, you practice, but there's a little bit of luck. I don't necessarily think the better team always wins in the tournament. Well, the nice thing about NBA basketball is you've got 7 games.
That's right.
And you're going to find, the best team. And it's like, it's grown men basketball. They're bigger, they're stronger, they're faster.
Right.
And so when they play, it gets really, really entertaining. But listen, we're going to talk about that probably for 15, 20 minutes a day.
Yeah.
So
I give you that point. It's wonderful that they play for 30 days out of a year in the playoffs. I think it's a wonderful thing, Troy.
Well, with that being said, last thing on the ZOTA rundown today. I don't watch the Oscars, but I know a lot of women that do at night, and some guys. And I don't think Bob Dylan's movie won much this year. Correct me if I'm wrong, but Bob Dylan to me should win everything all the time. He's one of my favorite artists of all time. So I was interested, Dan. You're a little bit older than me. You grew up in the mean streets of Chicago. What was the rock and roll when you were growing up in Chicago? What were the boys listening to?
Well, I mean, this, you're talking when I was in late teens, early 20s, that was the 70s. So disco was dominating the scene in most, I would think, metropolitan areas.
Oh dear
with
gosh.
that coming to mind, it got to a head though. People kind of said, I can't take disco anymore. And you know what they did? This was at either Wrigley Field or Comiskey Park. There was a huge rock disc jockey called, I forget his name right now. Somebody could look it up or they could tell Troy about this. But what they did is they went Comiskey Park, one of the big ball fields, and they had a disco demolition night where you bring all your disco records and they'll burn them. Right?
Oh, man. Yeah.
They'll burn them. And it was a big deal.
I could get on board with that. Yeah, I could definitely get on board with that.
It's like everybody said enough. But Bob Dylan is an interesting, Bob Dylan, I don't think, Troy, I've ever been able to understand more than 2 words he said, even when he was younger. Yeah. All I remember is, I like Irish folk music, growing up in an Irish family, Irish culture, Irish folk music. And I used to listen to a band, or I still do with the kid, the Clancy Brothers. Good.
Okay.
Irish folk music. Well, when the Clancy Brothers were in Greenwich Village in the 60s or 70s, and they were doing pretty good as an Irish folk band could do, who they really latched onto, Bob Dylan, that's when he was coming there, right? So he was like, I don't know if he was 17 or 18. So he became friends with the Clancy Brothers. And they were saying, even back then, he'd be writing these songs that were like, 95 verses. He just had this mind that could just keep going. But, they didn't see, no one saw that, he would turn into what he turned into. But I would just, again, I'll just on record, I've never been able to understand more than 3 words the guy said.
Well, listen, we better move on because you're hurting my heart a little bit. So
I'm sorry.
No, that's okay. That's all right. Listen, I
do like him better than LeBron, though. I'll tell you that right now. If that means anything.
All right. I hear what you're saying. I appreciate that. Okay. So this, for those who, this is going to be a show where we talk about markets and things like that. But a quick bio. I've said it before. Dan was a market maker forever, and he really pioneered options education. And so Dan has taught, thousands of people how to trade options. And, it's an honor to have them with us and be with us in the mornings. My story is a little bit different. I took Dan's classes when I was a software developer. And he really taught me kind of the ins and outs of trading. And in that, one of the things that as a software developer, me and some buddies made was Option Omega. And we wanted good backtesting. And I want to show you real quick. And again, if you are new to backtesting or you are very old at backtesting, I think this can be helpful. If you have no idea what backtesting is and you're completely new to options, hopefully this is helpful. And so what are backtesting and what do we do? And then we're going to talk about markets a little bit, but I'll go through this real quick. What is an option? Let's just talk about that. And again, if you have been trading options, just be patient, because probably a couple years ago or a couple months ago, or let's be honest, a couple of days ago, you didn't know what it is, and now you do. So what are options? They're financial derivatives that give buyers the right but not the obligation to buy or sell an underlying asset at an agreed upon price and date. So it's a contract, right? And it's a contract, and the way people talk about it all the time is it's like insurance. Well, we can talk about that, but it's a good starting point. It's like insurance on your underlying. And so if you have Apple stock and you want to try to hedge against it, you can use the instrument of an option to hedge. The nice thing about options are there's neutrality to it. So if you buy stock in Apple, you make money if the stock goes up, you lose money if the stock goes down. Options, because they're more complex instruments, have different ways of making money. And so, for instance, you can set up a trade using options in a stock or an index to where some people think the market's going up, some people the market's going down, some people think the market's not going to do anything for a little while. Well, you can make money from that in options. So there's a neutrality. You still have profitability through neutrality. You also have different time horizons. So whereas the Apple example, you think Apple's going up, but you think it's going to go up in the next year. Well, if you think it's going to go up in the next year, you're just going to have to hold that sucker, right? Even if it goes down in the meantime, you might think it's bearish for a while. And so you're constantly having to time the market. With options, you can have different time horizons. So you can say, I'm long short-term Apple, but I actually think it's going to go down in the long term. Well, or flip that. You're short in the short term and you're long in the long term. Well, with options, it gives you the ability to structure trades to where both of those things can be profitable. And that's what I love about options. They're unique in that you can do some pretty complex things with them. Options, the reason the pricing of the options works different is because options don't use delta. They just don't use delta. So an Apple example, you are buying 100 shares of Apple, you're long 100 deltas of stock. So for every dollar the Apple goes up, you're going to make $100 if you've got 100 shares. That's what we call a delta. It measures the change in options or in price when the stock price moves. And options have that. But they also have other Greeks. So they have gamma, which measures how much the delta changes, right? It's not a 1-to-1 ratio. That the delta can move according to gamma. You've got Vega, so you can profit from volatility as volatility goes up. And we're going to look at an example of that here in a minute. You've got Theta, which is one, if you make a living from selling options, you love Theta, you hold Theta close to your heart, you probably have a tattoo of it. Theta is how options decay. And so if you're selling an option, you're profiting from the decay in that option. And then you have Rho, which no one cared about for a long time. And suddenly people are starting to care about a little bit. So it measures the change in option price according to interest rate. So why backtest options? Well, let's say you have a position, you say, I'm going to put on something that, if you're new to it, it's called an iron condor. And we'll look at examples later this week of iron condors. Well, how do you know if that strategy would have worked? Because these contracts are constantly expiring. You have data that these, depending on the underlying, some expire every day, some expire, once a month, blah, blah, blah. How do you know what has worked through time? Well, that's what backtesting comes in. You can see how it performed historically, or it may perform in the future. Everything's backward looking. It's not forward looking. This is not financial advice. This consult with your financial advisor, but these are backward looking. And so here's the problem, the pitfalls of backtesting. A lot of backtesters use end of day data because the data is so massive on each contract, on a huge option chain. It's lots and lots of data. And so what people have done in the past is they've chosen one particular price, usually at 3:50 p.m., 10 minutes for the market close. And that works for a lot of longer term options. If you're selling a 90-day contract, that might be okay. But just to give an example from a couple of years ago, the future, let's say for the futures opened at 38.97 and they closed at 39.27. That's a 30-point range, right? So a Condor that day probably would have made money. A standard end of day backtester would have looked at that and saw at the end of the day we had a 30-point range and said, well, great, like your trade would have made money. But the reality is that day went between 38.54 and 39.61. So there was a huge range. Actually, Friday would have been a perfect example too, so any shorter term trade would have really been affected by that. And that is why we use 1 minute data and we go back to 2013. So you can look up optionmega.com. We'll put stuff in the description, but that's what we do. And Dan, we'll look at some examples of Option Mega here in a second, but I wanted to return real quick just because you have too much knowledge, much more than I do. I wanted to look at some trades. What are you looking at in the market right now on a day like today? We're opening up here, in a couple minutes, and we are, we're up a lot since Friday. What are you looking at today?
Well, I mean, the couple things to be looking at the opening. One, just, and again, I'll give it a couple hours, right, to see, because of the big ranges, there's a little more respect, right? There's a little more respect that because of the big, the average candle of 92 points last week, I'd be looking for, if we're opening up, VIX gets to 18 or 19, and we think, so people might think, well, I'll be looking at some short Vega strategies, or strategies that would benefit if volatility goes down. But the interesting thing right now is volatility, and I think I was talking to Troy about this last week, volatilities have been up, right? So the strategies that have really worked well last week are strategies that you wouldn't think in a high vol environment, like a double calendar or something, or a calendar or something like that, that would benefit if volatilities go up. So I'm more looking at this week would be, or today would be, personally, I might wait till lunchtime and just see kind of, does this look like we're going to get a continuation of this up a bit? But it doesn't, if the VIX stays up at 20, it still would be looking at iron condor or credit spread type stuff. But the thing is, though, you haven't really got paid on those from a volatility point of view from last week, because the vols have stayed up, right? So really, probably best are strategies that benefit when there's a move, right? Strategies that benefit because you're getting such a wide range. That's why, like in the Options Omega community, they call them RICs, right?
Mm-hmm.
Troy, is that the word? RICs.
Yeah. Reverse iron condor.
Yeah, reverse. I like the RICs. I used to reverse iron condor. And it's an interesting thought, isn't it, Troy, when you think about it? If the normal, like, let's say you're doing range bound or whatever trade you're doing, if you're saying, I absolutely would not do that trade, it's not working. Well, shouldn't it be, well, wait a second. If it's not working, how about the opposite of that, right?
Yeah.
Right. And that's why, you look at an iron condor, for example, in the last week, it hasn't done bad because with the high volatility level, you get so much more room or protection right? So you get a lot more room, but they haven't really made much, but they haven't really lost much. But
Yeah.
the opposite of an iron condor, and maybe we're going a little bit too fast on this, but
Sure.
the opposite of an iron condor benefits more from that. So I think you have to be I think you have to really look at the guardrails, Troy.
Yeah.
Where the market, where some of these numbers are, like the expected move for this week, which is a pretty good number. The expected move for this week is, where did I write this down here? Up or down 120 points. So we closed at the SPX at 59.54. They're saying there's a 68% probability we're going to be between 58.34 and 60.74. And that's a pretty good number. So that's up or down 120. So I would expect more volatility. I would wait a little longer in the day to make my decisions unless you're doing spec. But I think this is more of a much less, there's some things you can do from range bound, but this is a little more speculative stuff, because you're just getting, I mean, again, I think this was the biggest candle week maybe in a year or two where you get, so I think that says it right there, that even though net we may not be up or down much this week, as one of your graphs showed, we're going to still have quite a bit of intraday movement here in a low, and there's not a lot of big news this week.
Yeah. Let me ask you this, Dan. I mean, you're showing that chart and you say the expected move, you said, is 120, I think, for the week. And
for this week,
just talked for this week. Yeah. We just talked about selling, options, how a lot of income traders make their money from Theta, right? And so the options are going to decay through time. So let me ask you a question from a new perspective, someone who's new to options, who hears that and says, well, I can make money from Theta. How do I do that? And then they hear someone say, well, the expected move's 120 points. Why don't I just sell the 120 strangle? Why not do that, Dan? Why not do 100, set the expected move at the beginning of the week and just sell the Condor, or sell this, we'll talk about naked selling tomorrow, but why not just set it and forget it like that?
Yeah. And you can, it's just that's a really good question. That's a really good, that's a really good question. Why don't you just, okay, like Troy said, and let's think about that. Why not sell a call 120 points up or a put 120 points down? Here's the reason. Well, if we take a step back, the cost, right? If you sell a naked, just a naked put or call, your margins are going to be astronomical, right?
And for those who don't, for those who are new to the game, margin is when you put money in a brokerage and you have a specific level of options trading, you can sell stuff in it. Your brokerage is going to let you put on positions that perhaps you can't cover. That's what's called margin. But they also are not dummies. And so if you're selling something with a very high probability of winning, but a very high max loss, they're going to make you account for that in your brokerage. Is that right, Dan?
Yes, they will. So that's why generally I'm not a big proponent of naked options, but it's not for the reasons that people might think of. I mean, if you talk, for example, like Troy, like selling an out of the money put, right? So, if Microsoft is 300, are they showing my screen or no?
Yeah, I'll show. I got you.
Okay. So if you look at Microsoft is $396. Well, I can sell, this is just an example, March 28, 25 days out. And if I sell a March 28, 380 put, well, the 380 put has a delta of 25, but that would be considered a naked put, right? There's no, and this is a typical graph. It's interesting. If you call your brokerage firm and you say, well, I'm doing it covered right, they'll say, you're a good man. That's a very conservative strategy. You're a good man. and then my brother calls up and says, I'm selling a put. You are not a good man. You are a speculator.
Bad boy.
Yeah. And then even if you told them that the graph is it's the same trade, basically, and they'll say, I don't know what they'll say, but they are basically the same trade. But the reasons I don't, when you think about selling a put, and a lot of people do it, Troy, this concept of cash secured put, right? And it sounds very nice, right? At times I was confused, cash secured put, right? And it's just saying, okay, I'm going to sell this put for $4 in Microsoft. It's 25 days out is this put. Well, in a basic, margin account, at $398, I get my $4, and as long as Microsoft doesn't close under 380, I get to keep my $4. So I get $400, and that sounds great, doesn't it?
Sure.
But the problem with that is the cash secured part of the equation says you got to have enough. If we close under 380, you're obligating yourself to buy stock at the strike price of 380 less your $4, which would be $376. And you say, wow, that's pretty cool. I've got this gig here called selling puts every month. I can bring in money, right? A nice cash flow. And this is a stock I like, but I also got this where I can buy the stock almost 20% lower if it goes down, right?
Yeah.
Well, the problem is you're making $400 divided by, it's going to cost you like $39,000 to buy the stock. So your yield goes way down. And so my proposition would be, why the heck wouldn't you go buy, here, if you go buy a put 30 points lower at $1, it's like, would you rather make $4 on 40 grand almost? That's the cost to buy 100 shares of Microsoft. Or would you rather bring in $3? I'm going to go buy a 350 put for $1, right? So if I do a cash secured put in Microsoft or a covered right, well, we didn't get to that, but a cash secured put, I'm going to put up 40 grand. But if I say, you know what, the name of the game is yield, I'm going to go buy this put at $1 against it. And so would you rather make $4 on 40 grand, or this would be a credit spread, $3 on, now my margin is 3 grand, right? Again,
that seems better.
It seems better. But here's the big thing. If you bring this discussion to SPX for a second, Troy, I want to say, here's the number one reason. Let's just say you had a customer, Troy, that had a lot of capital. And they say, hey, Dan, I don't care about margin. I can sell a put, right? And I'm going to tell you the number one reason that I wouldn't, as far as selling a put, and it's called August 5th.
I was waiting for it.
August 5th. And it just means that what people think, like, okay, let's say I have the money and I can buy it. But the real problem is if you sell an out of the money put, let's say an SPX, and Trump comes out and says something crazy, or, Zelensky comes out and says, something crazier, right? And all of a sudden the VIX goes from 19 to 35. Right? It's Houston, I got a problem. How many people on August 5th, how many small traders that were doing nakeds on August 5th were saying, oh boy, my account says I'm down 60 grand and I only have 20 in the account. What do I do? You don't want to have to go back and buy back options, and that's what the brokerage firm would say. Okay, you don't have the capital, go back and buy those options. Try to have this conversation with your brokerage firm. Sir, the VIX is 55. I don't want to buy back my $1 option at $92. Well, you lost your negotiating power, right? You don't have any more capital in your account. So I think when people think of naked options, number one, go buy if you're selling a put, go buy a put, number one, at 20% of the value, 10% of the value. it's crazy in my opinion not to. But remember, the biggest concern for a naked put seller is once or twice a year, or once you have an August 5th, it's going to cause massive problems, right? If you're not careful, right? And so it's not worth it, right? I mean, what's the unless you're like, if you're very experienced and you're totally great at risk management, but still, I mean, like, go buy a put for 20 cents. Are you kidding me?
Well, that's what we're going to spend this week talking about, is selling naked and then selling really wide stuff, and talking about and we'll hit that tomorrow. But to kind of put a stomp on today, because the market's about to open and we want to respect that. To your point, if you sold a 1 day, a 1 to 3 day put, right? Let's say you sold something on Friday naked, and you sold it August 2nd. Yeah. You sold it for, let's say you sold, I'll show this tomorrow. If you sold a 1 delta put, about as far as away, multiple deviations away, August 2nd, Friday, August 2nd, you sold it for 80 cents. You collected 80 cents credit on that, right?
Yeah.
Okay. Well, when you woke up Monday morning, that 80 cent credit that you collected was at a $24 debit. Now, you finished the day green because we rallied all day. And so you got to keep that 80% credit. But it's not about what you keep. It's about looking at the risk at it. Because what happens if we didn't go back up? You're talking about maybe a book wipe, meaning maybe all of the profits and then some you had to give back on.
What'd you call it?
People call it a book wipe. So you have a book of trades on and it's wiped off, a book wipe.
I never heard it. I never heard that. That's good.
And you can't say, in those moments, you can't call the brokerage and say, my dog ate my homework. They don't care. So anyway, we'll talk more about that. Dan, it's been an honor, the first inaugural. Thanks for everybody who hung out with us. And we're going to do it again tomorrow. And I bet we'll have some more fun stuff to talk about. As Mr. Rogers said, you'll have things you'll want to talk about, and I will too.
Yeah.
So, but Dan, thanks so much for being with us.
Thanks, everybody. Thanks.
All right, guys. Have a good day.